Hey, welcome back to the channel. My name's Phil and this is Grow Your Dough. In today's video, I want to explore why it's important for you to have a written strategy explaining how you're going to approach your investing. And I want you to consider doing this for each type of investment approach you use. And in today's video, I'll explain why that's important and how that's going to help you. So let's crack on with it. So there's plenty of investors out there, myself included, who've stumbled their way into the stock market. And we all make the same mistakes. And I want to try and help you to not make the same mistakes. The same mistakes include buying just one or two shares as opposed to spreading the risk across a range of stocks. Buying shares based on what somebody else says is a good share without you truly understanding necessarily why it's a good share or even if it is a good share. One of the most important is understanding what will bring you to sell a share. Any idiot can buy a share. It's deciding how and when you're going to sell a share that can be one of the most tricky and most difficult aspects of investing in the stock market. We're going to explore what to do with additional funds if they find their way into the account. And the reason a strategy document is important is because most of the time the markets over time will rise, but sometimes the markets take a sharp dip, and in that moment there's a chance that we might do a knee-jerk reaction that we might later regret. So having the strategy document there is like the mast of a ship in the storm. It's the safe place where you go back to that will keep you steady through the storm and help to see you out the other side. So what I've tried to do is produce an example strategy document that you can use as a template and you can flesh out for your unique situation, because everybody's situation is different, but I'm trying to give you a flavor of what should go into a strategy document and how you might structure it. And remember, you might have invested £20,000 into an ISA and you might decide just to use one strategy, for example, the stock rank ultra low maintenance, ultra low cost approach, and invest all of that £20,000 in that one approach, and that's fine. But you don't have to just do it that way. It could be that you invest £5,000 in a stock rank portfolio in April, and maybe you pick up another stock rank portfolio of £5,000 later on in the year that you only rebalance half yearly, or you use a different strategy. Each of those might need a separate strategy document. You might be prepared to tolerate more risk in one strategy than you would in another. And that would be captured in your strategy document so that when things got choppy, you go back to it and remind yourself what you're trying to do. So let's have a look at the document and see the things that I go through and the resources that I highlight. Okay, so here I am looking at a Google Drive document that I've shared the link to below. And if you want to use this document, what you do is you go up to the top left-hand corner and you go File, Make a Copy, and then you can save it for yourself and you can edit it as you see fit. I put a general text explanation at the beginning telling you how to copy it and explaining why entering the market without a strategy means that when things get challenging, you might make a rash decision that goes against your best interests, where if you have a strategy with clearly defined justifications, it'll help you to stay disciplined. And I put a link to this video in here too. Okay. So the first question I ask myself when I'm thinking about a strategy is how much am I going to invest in just this strategy? Again, you might have £20,000 in an ISA, but you might not want to invest all of that £20,000 into that approach. So I ask you the questions. You'll need to work this out for yourself. Remember, this is just one strategy. Could be that you divide the funds available to you across several strategies, in which case you'll have several versions of this document. It could be that you're not quite ready to put all of your £20,000 into this strategy so maybe for the first quarter, you just think about investing £5,000 when you rebalance either quarterly or half yearly. Maybe you're feeling more confident and so you invest more funds. All of this can be captured in this document. I've added a justification column. And it might read something like this: I'm investing X thousand pounds into a factor-based approach that rebalances annually using the Freetrade basic account, as this reduces the impact of fees on the funds invested. This approach will form 25% of the funds I have available, and I will look to invest the remaining 75%, and then I've given you some options at different times of the year, using another factor-based approach, maybe in a non-UK market. And what I've done is I've put links to videos which might help you consider how you respond to that. So which broker account to use for ultra low cost portfolio, how many stocks should I have in my portfolio and the cost implications of that. And I've also linked to Stockopedia articles that might be useful to help you consider that too. Okay. So I can't fill it out for you because it's unique for your situation and the amount of funds you have available to you. So the next question I ask is, what type of shares am I going to buy? So here I've put, for example, using a factor-based strategy to select UK companies with high Stockopedia stock ranks with a market capitalization of greater than 10 million. Okay, so that's what we're using at the moment, but it could be that you choose over 50 million or 100 million. The fact of the matter is, if you use a Freetrade basic account, you probably won't be able to buy any companies that are less than 600 million anyway. So that sort of takes things out of your control in that respect anyway. And the justification is this is a really low maintenance strategy with good performance over several years. And that's evidenced by the videos that I highlight here. What is factor-based investing and the screening and allocation process. There's a Stockopedia stock rank screen. And there's also a link to the historical performance of stock ranks. So that should help you remember. How many shares am I going to buy? I've put 20 per portfolio. You might choose to do 30 per portfolio. The justification is it reduces volatility of returns and spreads risk across different stocks, industries and sectors. Again, I link to the video around portfolio constructions and how many stocks should I own in my portfolio and the article that was referenced in that video too. Which account am I going to use? So for an example, I put Freetrade ISA Basic. It's low cost and stocks available tend to be mid-cap stocks with narrow spreads that reduce costs, and it's placed inside an ISA to avoid tax, which also saves me money but also saves me the hassle of having to do tax returns specifically for this. Again, I link to the videos that support this. How are the funds going to be allocated to each stock? So do I allocate them equally or do I spread them with some having more funds than the other? And we're going to use the allocation spreadsheet in this case that we used in the allocation video, which shows you how to divide your funds available across, in this case, the 20 stocks. And the justification for doing that was because the reference portfolio that we use from Stockopedia, the mechanical reference portfolios, which are alluded to in these videos here, performed well and they had equal allocations across each of the stocks. A key question that we haven't really covered yet, and one I want to share with you is, when do I sell? It's really important that when you go into a trade or a position, you understand what your exit criteria are. Because if you don't understand that going in, it can get really messy later on. Okay, so I've put, we only sell at the time of rebalancing. And the reason I've put that is because this is an ultra low cost, ultra low maintenance. And if we change that idea of selling at different times, that means suddenly we have to start monitoring this portfolio. And that's not what this portfolio is about. I'm not saying that's a wrong thing, but for this portfolio, it's designed for time poor people who don't have the ability to monitor their positions on a daily basis or a weekly basis. So we only sell at the time of rebalancing, and that could be once a year, twice a year, or quarterly. Okay, so here's the justification. I'm time poor, so this is a low maintenance portfolio, and Stockopedia's mechanical portfolio use the same approach to good effects. So again, I link to that video, and I link to the video as well supporting that. Okay, so what happens if extra funds flow into the account? So extra funds can arrive in the account for two reasons, okay? One can be that you deposit extra funds. Maybe you're dripping money into your ISA each month. Or it could be that you receive a dividend. And if you don't know what a dividend is, please check out the video I'm linking to above. Recently recorded a video explaining what dividends are. But basically, a dividend is a reward, a financial reward for being a shareholder of a company, and it's paid directly into your account. Okay, so here's my advice around how to handle extra money coming into the account. Chris asked this question on one of the videos. And I am suggesting, regardless of what type of account you're using, if you're using a rebalancing strategy, which is like quarterly, half yearly and yearly, if you have less than 3 months to go to the rebalancing period, I'm suggesting that you just sit and hold on to the money. And the reason I'm suggesting that is that you need to give the stocks a chance to appreciate. And maybe you don't have a massive amount of money to invest as you're dripping funds in. And if you were to add more money to the positions you have, how do you decide which one you invest more in? Is it the one that's performing the best? Is it the one that's performed the worst and hope it recovers? I just think it's easier just to hold on to the funds until you rebalance. So here's a justification. It says that any stock purchased needs time to appreciate in price, and less than 3 months might not be enough time to overcome the spread and stamp duty. So when you buy a stock, straight away, you're already lost some money. And that's why you always see when you initially buy a stock that maybe you're down by 1% or 2%, or maybe a little bit more for even some stocks. So you need to give the stock time to overcome those losses. And so that's why I'm saying give the stock 3 months to recover. Otherwise, you're better off just maybe holding on to your funds. Okay, so what if there's more than 3 months to go? Again, that'll depend on the type of account you're using. If you're using an account which charges commission on trades, for example, AJ Bell, then buying small amounts of stock will prove really expensive because of the overheads of the transaction fees. So if you really must invest the money, buy more of a stock you currently own. And the reason for that is that whilst you'll incur costs for buying, if you buy more of the same stock, you'll only pay one transaction fee to sell the whole bundle of stocks later on. So it's more efficient. Okay, so if there's more than 3 months to go and you want to invest more of your funds and you're using a commission-free broker such as Freetrade, calculate the average value of the stocks held. So that's the total portfolio value divided by the number of stocks you hold, and that will give you the amount of money that you perhaps want to invest in a new stock. Rerun the Stockopedia screen and spread the amount available across the number of stocks that can be bought for the average stock value. So let's imagine that I'm using my Freetrade basic portfolio that we built earlier. I invested £1,000 across 20 stocks, and that was about £50 for each stock. Let's assume that a month on, I've got some extra money in my account, and let's say that the shares haven't appreciated in price, so there's still £50 a share. I might have £200 flowed into my account as a deposit from my bank account. So what I'll do is I'll buy 4 extra stocks with £50 each, and I'll be choosing the top stocks from the screen when it's rerun. And if a stock reappears that you already hold, just move on to the next stock. And the justification for that is that by adding more funds to one stock, we're skewing the spread of cash across the holdings, which might result in increased volatility. So it's better to have more stocks than to be overweight in a particular individual stock. So the last question, how often will I rebalance? That's a decision you're going to have to work out for yourself using the material that I provided. And it's sort of a function of questions 1, 2, 3, and 4. It's a question of how much money am I going to invest? What type of shares am I going to buy? How many shares am I going to buy? And what account am I going to use? And I've linked to the video there which will help you which broker account to use, because the rebalancing exercise means that you incur the spread costs every time you rebalance. But it could be that the returns generated by quarterly rebalancing well outweigh the penalty of the spread costs. What I've said is, as a minimum, the portfolio should be rebalanced annually, where the screen is rerun for new candidates. And this is really important, this last one. When you're going through the rebalancing process, and I'll do a video about this later on when we come to the point where I need to rebalance. When you come to the rebalancing process, don't sell any of the stocks in your portfolio until you have your new list of new candidates, as you don't want to sell a stock only to have to rebuy it again because it's in the top 20 stocks in your stock rank screen. And the justification for doing that is it minimizes the impact of costs and trading fees if applicable. So again, there's supporting videos that should help you decide when you want to rebalance. And it could be that actually you're a really, really busy person and actually annual rebalancing is fine. Thank you very much. I don't have the time to come back and do it again. So there it is. I'm encouraging you to save a copy of this for each strategy you employ and to come back to this one. We only sell at the time of rebalancing. So strategy is useful when you consider an image like this. So this is a stock price graph, the Standard & Poor's 500 index in America, the S&P 500. It's the 500 biggest firms in the US. And this graph is showing us the history of that index from 1872 right up to present day. And you might be thinking, blimey, that steep up climb up here, the only way it's going to come is down. But you just need to appreciate that this is a standard graph, and that doesn't really help you when you're starting out with very low figures. So let me explain what I mean. So for example, here the stock price is at close to 200, and to double, it only takes one of the squares on the graph. But if I come here where the value is 2000, you have to go up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 squares for it to double. So that's not really a helpful graph when looking at huge changes in price, because from here to here was just a doubling of the value of the market, but it took from here to double more recently. So let's use a logarithmic scale, and suddenly the graph doesn't look quite so precipitous. And so what you can see, this graph runs from 1872 right up to present day. And what I want you to notice is, whilst there are scary periods of underperformance, the overall performance of this graph is up. And that's why investing is safer if it's a long game. But I want to just put over some moving averages. So this is a smoothed version of those lines. And again, on the whole, the market rises. You can see there's a bit of a flattening in this curve here, where through the 70s, 60s and 70s, there's a flattening, but on the whole, it's up. That's why we want to get our money into the market over the long term. So let's look at a few of the events that are being presented here. So the first and most obvious thing is this huge drop in the 1930s. That is the Great Depression. Lasted a long time. By far the biggest collapse in the stock market ever. Here you can see another drop, Pearl Harbor, and the US enters World War II. There's another drop here, Vietnam War and the Cuban Missile Crisis, where we came to total catastrophic annihilation of the whole world as Russians deployed nuclear missiles in Cuba. The late 60s and 70s were difficult, and as we go through the 70s, we're at the height of the Vietnam War here. And then we're up to the 1980s. Black Monday, the single biggest drop ever recorded in one day on the stock exchange, 22% in a day. And here we can see the build-up of the dot-com boom. As technology and the internet started to really get traction, and anything with a dot-com suffix went up through the roof in price until the bubble exploded, and we had 9/11 during that period too, right down to the bottom where there was the start of the war in Afghanistan. And then things started to improve again, and then we came to the global financial crisis, where really bad investments were wrapped up and missold, and that all unraveled, banks folding, collapsing, and then this bull run that's been running, a really profitable period. And then right at the end, look at that, that's the COVID pandemic. I'll zoom in a bit. That's the extent of it. And you see some of the other swings we've seen. There's been massive stimulus and financial injection put into economies by governments to prop them up. And in fact, some businesses have done better out of the lockdown period than others, and have thrived. You think about Amazon, delivery companies, etc., Zoom, telecommunications companies. So a trading strategy helps you when things like the COVID pandemic hit and you see your portfolio take a nosedive. If I can show you how aggressively the stocks recovered, a sharp dip and then a huge rally as they recovered. In America, particularly in the stock market, there's a lot more retail investors like you and me, and they're taught to buy the dip. That's the message, buy the dip. If the share price drops, buy the dip. If the stock market struggles, buy the dip. So there's typically a strong rally that comes back out of those corrections as they're called. So having a strategy document to remind you of your approach, when you buy, when you sell, how much you buy, how much you invest, what you do with extra funds, can really help you when things get difficult and the seas feel quite choppy. Keep reminding yourself that the stock market pays off in the long term, as we've seen in the graph. It's about 145 years worth of investing history in that graph. If we keep investing over the long term, we'll reap the dividends and the rewards. That's what we're trying to do. So I hope that helps you to build a strategy document that you can use as a reference point, and that you realize that each strategy document might be slightly differently depending on how you're choosing to invest those particular funds. Please feel free to make a copy of those and take them away and use them. And as we start to explore other strategies, it might be that some aspects of the strategy document become a little bit more complex. Maybe we start to weave in more complex rules around selling for those individuals who have more time on their hands and want to take a more active role in monitoring their portfolios. But this is a really good starting point for new beginners and people who are time poor, because the rules are simple, it's low maintenance, and it's low cost. And I'm trying to get as many of everyday people to start taking control of their finances and investing in the market so that they can grow their dough and secure their future. So that's it for today. If there's any comments or anything you'd like me to answer, please feel free to add comments. Check out the videos that are coming up in the end card. They'll show videos that might be appropriate for you to watch next. But if not, I look forward to seeing you next time. Take care. Bye.